The Indian banking case, it's fairly interesting. If you go back to the early 90s, the debate started pretty much everywhere following the crisis in the US, the banking crisis in the US then. Much less of a crisis than what we have had over the past year and a half, but nevertheless, nearly 200 banks failed, as far as I remember. About this balance between regulation and deregulation. And India was just about starting to liberalize its economy, along with it, the banking sector itself. The liberalization process started in 1992, really. And the question was, what kind of a balance would the country strike between regulation on the one hand and economic reforms or liberalization on the other hand? What we find today is that regulation essentially remains, a lot of it in place, and yet the banking sector, more than ever, has been fairly resilient to the crisis. So what I plan to do in this presentation is try to give you an idea as to why the Indian banking sector was not affected adversely, as in the UK or the US, and whether it was a matter of deliberate policy or whether it was a matter of the fact that the government simply didn't do certain things which actually turned out to be a good thing. Right. Now, let's sort of try to recapitulate what the crisis was all about. It started in the US, of course. There's a lot of cheap money available, in part because the Chinese and the Japanese were buying huge amounts of US securities. And the Federal Reserve Bank was maintaining interest rates at a fairly low level since pretty much 9/11. That money gave rise to a wholesale market for money market, which allowed balance sheet expansions of banks in ways which were not seen before, because banks have typically been or traditionally been institutions which can expand their balance sheets only if they take on deposits. Now, the existence of cheap money in wholesale markets meant that they did not have to leverage their deposits. They could do it in other ways. Part of the problem was also that the balance sheet expansion took the form of subprime loans, the so-called ninjas, in many cases. That was possible in turn because of the securitization, that mortgages were given, they were securitized, they were taken off the bank's balance sheets, so the bank had to worry about it for a very small period, and the cheap money came into play. The cheap money provided the bridge finance between the point when the securitized assets were being offloaded and mortgage money was being given to the new borrowers. Right. So that is how it happened. And once this process came to an end, once the banks started going belly up, and especially starting with the Lehman crisis, then the uncertainty about the asset quality kicked into play. And essentially what happened is that since the mortgages had been securitized, pretty much each bundle, each bond, asset-backed mortgage, asset-backed security could have an element which could go bad. Nobody knew where they were. Nobody knew which bank had it. Nobody knew how much of it was there in the balance sheet or in the system. As a consequence, the banks stopped lending to each other. The money market essentially froze up. So even when the Federal Reserve was pumping money into it, nothing pretty much was happening in the money market. Right? There's a huge liquidity crisis, and as we know from historically, banks don't go belly up because their net worth goes negative. Banks go belly up because they lose liquidity. Right? And this is essentially how the crisis started there. This is how the crisis started in the UK. Right? Now, given that background, let's see what happened in India. So let's start with the story about cheap money. Now, India has experienced a fair amount of forex inflow by Indian standards, mind you. Yeah, we have to keep that in mind. Over the last 10 years, very much so in the form of portfolio investment. That has led to a huge spike, as you can see, in the stock prices. This is very much driven by foreign investment, portfolio investment. And as you know, in economics, we can decompose money supply growth, what contributes to it. It could be, for example, government borrowing, it could be printing of new money, it could be inflow of forex, right? And these are the contributions of forex. And you can see that that's actually fairly high. The money supply growth has been driven, except in this particular year, to a large extent by forex inflow. And in this year, it's basically when the government policies, fiscal incentives kicked in, so most of the monetary expansion was due to budget deficits. But look what happened, how the central bank reacted to it. The central bank, these are, in India, unlike in many other countries, the central bank does not use a bank rate in order to control monetary policy or the supply of money in the country. It uses the reverse repo and the repo rates. Repo, as you know, is a repurchase agreement. Or it uses the cash reserve ratio. So these are indirect, these are sort of like the bank rate, and this is a direct one because you're forcing banks to maintain greater cash with the Reserve Bank or the Central Bank of India, right? And therefore, you suck money out of the system, right? Look at the rates. Since 2004 up until September of 2008, when the Lehman crisis happened, all these rates have been going up. So essentially, all this while money was fairly cheap in the US and in the West in general, right, money in India has been fairly expensive, right, fairly tight. Okay, so that's the first big difference. So first of all, there has been inflow, not in the US scale, largely because India's capital account is not fully liberalized, right? It is not a fully convertible currency. However, to the extent that forex did flow in, the central bank was very mindful of it and was using monetary policy to control money supply growth in the economy. And the reason is very simple, that the concern in India has been, for the central bank at least, which is fairly independent, it has been inflation. Inflation rate in India for consumer prices had been touching double digits, especially food price inflation, which is currently running at around 16% per annum. And because of that, a tight monetary policy was deemed useful, right? So the first part of the puzzle, cheap money, not so in India, very much not so. Second part of the story, credit expansion. Now, to give you a background of how it works in India, so all deposits in India are preempted by the Reserve Bank in two ways. First, there's a cash reserve ratio, which varies between 5 and 10%, depending on what the monetary policy stance of the Reserve Bank is. And then there is a statutory liquidity ratio, which means 25% of your money has to be in what they call approved securities, which essentially means government bonds, right, which are highly liquid, right? But this means between 30 and 35% of the deposits are essentially taken away by the Reserve Bank at the very beginning. So the maximum you can lend, if you are dependent on deposits, if there is no large-scale wholesale money market from which you can raise resources very cheaply, the maximum you can lend is about 70%, roughly speaking. So look at those numbers over there. If you start in 2000, which is when the 9/11 essentially happened soon after that, the cheap money policy in the West started soon after that, right? If you look at what happened, up until 2004, the credit to deposit ratio was below 60%. It started climbing after that, so there has been a very serious credit expansion since then. However, we are still talking about less than 75%, right? It's nowhere. They are entirely, so this particular credit growth is entirely deposit funded. There was no dependence of banks on outside money, on the money markets, in order to finance this. Right? Only the foreign banks in India, which are branches, which are not wholly owned subsidiaries, can actually use parent money in order to expand their balance sheets. Right? All other Indian banks incorporated in India, they're dependent on their deposits. The other thing is also, this is March 2008 figures. Look at the composition. Right? Where has the credit gone? It hasn't gone into mortgages very much. Nor has it gone very much into other personal loans. If you look at these numbers over here, mortgages account for basically about, this is the blue, which is 11.7%, personal loans 9.5%, and so on. So most of the money has essentially gone to agriculture and industry, the real sector. So you're talking about 68% or 69% has gone to the real sector, right? Which is a very, very big difference. Right? So most of the expansion has been over there.